One of the most important things you need to do as a trader is to reduce risk. And one of the ways you can reduce your risk is by staying diversified. And you can diversify in a number of different ways. You can diversify by the products that you trade. You can diversify by the strategies that you use. You can diversify by the option cycles that you trade in. But one of the most important ways to diversify is just making sure that the products that you're trading aren't highly correlated. And what you should really be wary of is being too correlated to the broad stock market. In particular, we're talking about being too correlated to the S&P 500. Correlation risk in options trading. So avoid being too correlated to the market. That is our discussion for the day. And diversifying, it protects you. Why does diversifying protect you? Well, diversification protects traders from the risk associated with being too one-dimensional in their trading decisions. And there's multiple ways to diversify. As I mentioned, you can diversify by the underlyings you trade, by the strategies you use, by the expirations you choose as far as your option cycles. But one form of diversification that is often overlooked is diversifying by correlation. In particular, we're talking about correlation to the SPY, the S&P 500 ETF. And why are we focused on our correlation to SPY? Well, SPY is probably the best indicator of the broader markets as far as the US markets and really the global markets, right? So the S&P 500 ETF, SPY, that's typically what we use to judge our stocks, whether they're correlated to the SPY or not. Now, most stocks on the US stock exchanges, they have a pretty high correlation to the SPY, which when you think about it, it makes sense. When the market moves, most stocks tend to follow along, right? When the market makes a big move up or a big move down, most stocks in the stock market also are making a big move up or a big move down, right? They follow along, and vice versa. When a lot of stocks are making a big move up, right? The S&P 500 itself also is making a big move up, right? That just goes without saying, because obviously the S&P 500 is made up of 500 stocks. So when all the stocks are moving up, the S&P 500 ETF SPY is moving up. So how is this useful though? Well, it's wise occasionally to trade some underlyings that tend to move independently of the broader market, or even trade some underlyings that move inversely to the market, meaning they tend to move in exactly the opposite way. One of the reasons you want to avoid being too correlated to the overall stock market is because most traders are already long the stock market. Most traders already hold shares of SPY or VOO or some of the other S&P 500 products out there, right? And maybe you're heavily invested in those products, meaning you're really long those products. Well, if you're really long those products, you probably don't also want to be long Google, Microsoft, Apple, underlying stocks that are a part of the broader market that really make up a large percentage of products like the SPY, for example, right? Because they're almost like the same trade. If I'm long SPY and I'm also long Apple, they move so similarly. It's almost like trading the same product, and for diversification reasons, you really don't want to do that. So let's talk about checking correlation. So how do you check correlation? Well, it's available on many trading platforms. So when you go to your trading platform, typically they'll have an option in their watch list or something, so you can actually see particular stocks correlation to the SPY or SPX or whatever it is that they're correlating it to, typically the S&P 500 and S&P 500 product. On TASTYTRADE, correlation is displayed as core SPY when you view it on a watch list, and it's displayed as simply core when it's viewed in the overview tab. Let me switch to my trading platform because I'm on TASTYTRADE, and I'll show you this in action. So let me go to a watch list. So I'll go to my watch list for ETFs, and I have a column over here for correlation SPY. Let me move my head out of the way so you can see. So this is core SPY. Let's see if I can zoom in on that. So core SPY, that's correlation to SPY, and you can see what correlation to SPY is. It's going to be a number from -1 to +1. So what a +1 means, if it has a correlation of exactly 1.0, it means it moves exactly in lockstep with SPY. If it has a correlation of -1.0, it means it moves exactly the opposite of the S&P 500. It inversely moves with the S&P 500. If it has a correlation of exactly 0.0, there is absolutely no correlation between that product and the S&P 500. Most products are not going to be one of those round numbers, though. They're going to be somewhere in between -1 and +1. So if I go back to the trading platform here, so taking a look at these ETFs, if I wanted to, I could sort by correlation to the SPY. And you can see if I do a negative correlation, you see we have these volatility products, VXX, UVXY. These have an inverse relationship to the SPY. You can see they're -61 and -60 respectively. That means they tend to move exactly the opposite direction of SPY. If I go down a little further, I actually have a correlation of exactly 0.0. So this particular product here has absolutely no correlation whatsoever to SPY. It pretty much never moves in a similar fashion to the SPY. It's not positively correlated. It's not negatively correlated. It just does its own thing. That particular product, by the way, is USO. That is the oil ETF. So it's just a mirror of crude oil futures. And crude oil really is its own thing. It really doesn't follow the market in any way. It kind of trades in its own particular direction. Now, other than in the watch list, you can also get the correlation to SPY in the overview tab. So if I get this little right-hand gutter, this little side menu that pops out here on the TASTYTRADE platform. So this gives me a little overview, some general information about a particular ticker. For example, if I do AAPL for Apple, we have correlation right here. Right now, its correlation actually is pretty low. Correlation to the S&P 500 right now is only 0.59. That's a pretty low correlation. It's still kind of positively correlated to the overall market, but that's lower than what I would have thought. So if we go back to the slides here, one thing to note about TASTYTRADE's correlation figures, they are a 3-month correlation to the SPY. So they take, for example, the track record of Apple and SPY over the last 3 months, and that's what they derive that number from. So it's a 3-month correlation period. And what that means is that's about 66 days. Well, aren't there 90 days in 3 months? Well, we're talking about trading days, right? So 3 months worth of trading days is typically around 66 days. And as I stated before, if you're heavily invested in SPY, VOO, or other similar S&P products, it is wise to check correlation for potential new trades, because you may not want to keep getting that same directional market exposure. So those correlation numbers are somewhere between -1 and +1. A correlation above 0.5, we can consider that a positive correlation, meaning most of the time it goes in the same direction as the broader market, as the SPY ETF. A correlation below -0.5 would be a negative correlation, means it tends to go in the exact opposite as SPY. And a correlation somewhere in the middle, so somewhere between -0.5 and +0.5, we can consider that to really be non-correlated, meaning those two products, the SPY and then whatever underlying we're taking a look at, they tend to not really go together. They just do their own thing. So when I was looking at the TASTYTRADE platform, of course, I could, get these correlation numbers here in this column, but, you can filter them. You can find inversely correlated products. You can find non-correlated products, so those products that are somewhere around zero, maybe from -0.5 to +0.5, those would be non-correlated products. And it's a good idea to sprinkle some of these kinds of products in. So as of this morning, on the day I'm recording this video, here are a list of products that I saw that really have low SPY correlation. So these products tend to not be correlated in any way with SPY. They're not positively correlated. They're not inversely correlated either. They just kind of do their own thing, right? They just move around in whatever direction, and they really don't pay attention to what SPY is doing, what the market is doing. These products include BITO, which is a Bitcoin ETF. That's actually mirroring the Bitcoin futures, I believe. And you see Bitcoin, the futures of Bitcoin, really don't have anything to do with the broader stock market. Correlation 0.21, that's not correlated really at all. Gold, GLD, that's the gold futures ETF as well, 0.38. That's a really low correlation. GDX, now that is an ETF of gold mining stocks, and because they're stocks, they're equities, and they're part of the broader stock market, you would think they would move around with the broader market, but they really don't, because gold miners, these particular stocks are really tied to gold futures. So again, the correlation is really low, 0.41. SLV, which is silver, that's mirroring the silver futures. Again, just like gold, really doesn't pay attention to the broader stock market, right? 0.42 correlation. TLT, that's a bond ETF. That's the long bond ETF, 0.20. It's not really correlated to the market at all. Bonds just do their own thing. UNG, which is the natural gas ETF, it mirrors natural gas futures. Pretty much it's a zero correlation. USO, which we already looked at on TASTYTRADE, that is the oil ETF, and that mirrors oil futures, zero, right? XLE, which is a energy ETF. So this is a collection of energy related stocks. 0.25. And the reason these stocks don't really follow along with the broader stock market is because these energy related stocks really are tied heavily to oil futures and natural gas futures. So that's why the XLE ETF has a really low correlation. It's pretty much non-correlated to the market. XLU, which is the utility sector ETF, is a similar story, 0.33. It's not really correlated to SPY. So some key takeaways: it's wise to avoid being too correlated to the overall stock market. And that's because most of us are already invested. You probably already have a long-term investment account. Maybe you have an IRA and you've already got a lot of shares of things like SPY or VOO, or even some individual stocks like, Microsoft or whatever you happen to be, Apple, Google, Amazon. Those things are also really highly correlated to SPY. So sometimes to reduce your market exposure risk and your overall portfolio volatility, occasionally trading some non-correlated or low correlated or inversely correlated underlyings to reverse your market exposure, it's a good idea. So that's just some food for thought as far as correlation risk. It's something you should be mindful of. Don't have, 15 different positions open and, have all 15 or 20 of those positions with a very high correlation to SPY. Say a correlation of 0.7 or 0.8 or even 0.9. Those high correlation numbers means that all 15 of those positions pretty much move together. When the SPY's having a good day, all of your positions are having a good day. When the SPY's having a bad day, all of your positions are having a bad day. You want to mix and match a little bit. You want to make sure that, when the market is up, some of your positions are winning, some of them are losing. And when the market's down, some of your positions are winning, some of them are losing. It just helps smooth out the risk. It helps you sleep a little better at night. Peace, guys.